A venture capital fund is a pooled investment vehicle designed to provide capital to early-stage, high-potential companies in exchange for equity. These funds play a pivotal role in fostering innovation and driving economic growth by supporting startups that may lack access to traditional financing avenues. Venture capital funds are generally organized as limited partnerships, a structure that delineates clear roles and responsibilities between two primary groups, the general partners and the limited partners. At the heart of the fund's operation are the general partners. These individuals or entities are tasked with managing the fund's day-to-day activities, making critical investment decisions, and actively supporting the growth of the portfolio companies in which the fund invests. While GPs typically contribute only a small fraction of the fund's total capital, they are compensated through a combination of a management fee, commonly set at around 2% of the committed capital, and a share of the fund's profits known as carried interest. This performance-based incentive, usually amounting to about 20% of the fund's returns, aligns the GP's interests with those of the investors by rewarding successful investment outcomes. On the other side are the limited partners, who supply the majority of the capital but adopt a much more hands-off role. LPs can be drawn from a broad range of institutional and private investors, including pension funds, university endowments, insurance companies, family offices, and high-net-worth individuals. Their liability is limited to the extent of their investment, and they do not engage in the day-to-day management of the fund. Instead, they entrust the GPs with steering the fund's investments while they focus on reaping the potential returns generated by the fund's performance. This partnership structure, balancing active management with passive investment, has proven to be a robust model for fostering innovation and growth within the venture capital ecosystem. The life cycle of a typical venture capital fund spans around 10 years, unfolding across several distinct but interconnected phases that together define the fund's journey from inception to completion. The process begins with the fundraising phase. During this critical early stage, the general partners focus on securing commitments from prospective limited partners to build the fund's capital base. This involves crafting and presenting a compelling investment thesis, outlining the fund's strategy, and projecting potential returns in order to attract the confidence and backing of investors. Once the necessary capital has been raised, the fund moves into the investment phase, a period that generally extends over 3 to 5 years. In this stage, GPs turn their attention to sourcing high-potential startups, conducting rigorous due diligence, negotiating investment terms, and ultimately deploying capital into selected ventures. It is during this time that the foundations of the fund's future performance are laid, as the portfolio begins to take shape. Following the initial investments, the fund enters the monitoring and value addition phase. Here, the role of the GPs evolves from investor to active partner, working closely with portfolio companies to maximize their growth and success. This support can take many forms, including strategic advisory, facilitating key industry connections, helping to build strong management teams, and preparing the companies for later stages of development and scaling. Finally, the fund reaches the harvesting or exit phase. In this culminating stage, GPs seek to realize the value created in the portfolio companies through exit events such as initial public offerings, mergers, or acquisitions. Careful timing and execution of these exits are crucial, as they ultimately determine the financial returns delivered to the LPs and, by extension, the overall success of the fund. Venture capital funds utilize a variety of investment strategies, often distinguished by the developmental stage of the companies they choose to back. Each stage reflects a different level of risk, maturity, and capital need, shaping how and when VCs engage with startups. At the very beginning of the entrepreneurial journey lies the pre-seed stage. This is the earliest phase of venture funding, where founders are typically working to validate an initial idea, undertake early research and development, or build a minimum viable product, called MVP. Pre-seed investments are often relatively modest and frequently come from angel investors, accelerators, or specialized micro-VC funds. Beyond providing financial support, investors at this stage often play a crucial advisory role, helping startups refine their business models and prepare to raise a formal seed round. Following the pre-seed, there is the seed stage, where companies are a little further along, but still very much in their infancy. Startups at this stage are focused on developing their core product or service, conducting deeper market research, and building the foundational team necessary to drive growth. Seed funding provides the critical resources needed to transition from concept to viable enterprise, setting the stage for future scaling efforts. Once a company has developed a functioning product and demonstrated some degree of market traction, it may seek early-stage funding, typically in the form of a Series A round. At this point, the startup's needs shift from validation to growth. Investment capital is used to expand operations, build up a team, refine go-to-market strategies, and accelerate customer acquisition efforts. Beyond the early stage lies the growth stage, which encompasses later rounds such as Series B and beyond. Companies at this point are often well established, with proven business models and growing revenue streams. The focus of growth stage investment is on scaling aggressively, whether by entering new markets, developing new product lines, or pursuing strategic acquisitions to enhance competitive positioning. Through these stages, VC funds tailor their strategies to match the evolving needs and risk profiles of the companies they invest in, playing a pivotal role in shaping the growth trajectory of emerging businesses. VC investments are inherently high risk due to the uncertainty associated with early-stage companies. However, they offer the potential for high returns if the invested companies succeed. VCs mitigate risk through diversification, investing in a portfolio of companies across various sectors and stages, with the expectation that a few successful investments will compensate for losses in others. While the pursuit of financial returns is a primary objective for venture capital funds, their impact extends far beyond mere profit generation. VC funds play a vital role in driving broader economic development, fostering growth and innovation across a range of sectors. One of the most immediate and tangible contributions of venture capital is job creation. By investing in startups and high-growth companies, VC funds help build businesses which then create new employment opportunities. These companies often require a diverse range of skills as they expand, leading to the formation of new roles not only within the startups themselves, but also across their wider ecosystems. Innovation is another critical area where VC funds make a profound difference. By providing early and growth stage companies with the capital needed to pursue ambitious ideas, venture capital supports the development of cutting-edge technologies and breakthrough solutions. Many of today's most transformative industries, from biotechnology to artificial intelligence, owe their growth, at least in part, to the early backing of visionary venture capitalists willing to take calculated risks. Finally, venture capital is a key enabler of market expansion. With the financial backing of VC funds, companies are able to scale their operations more rapidly, enter new domestic and international markets, and enhance their competitiveness on a global stage. This not only strengthens the companies themselves, but also stimulates broader economic activity, opening new channels of trade, investment, and innovation. In these ways, the influence of venture capital reaches well beyond individual portfolio returns, helping to shape dynamic, resilient, and forward-looking economies. To sum up, VC funds are instrumental in nurturing early-stage companies, providing not only capital but also strategic support to drive growth and innovation. Through a structured life cycle encompassing fundraising, investment, value addition, and harvesting, VC funds aim to generate substantial returns for investors while contributing positively to the broader economy.